Okay, let's talk about the end of an era. I mean, for the last decade, we've lived under this golden rule of consumption. Fast and cheap.
Instant, yeah. Overnight delivery, 10-minute grocery.
Electronics available right now.
Yeah,
Well, feels like those days are pretty much over.
that's exactly right. We are now entering a period of, well, an enforced slowdown, where the price of all that convenience is about to skyrocket.
So that's what we're diving into today, how the two largest markets, India and the US, are suddenly, hitting the brakes.
And what that pivot from fast and cheap to slow and expensive is going to mean for your budget and your daily life.
What's so striking is the timing. Why are they both doing this now?
That's the fascinating part, the synchronicity of it. Both the US and India are actively pushing back against pure market mechanisms.
Pushing back in favor of what, though? What are they choosing over that efficiency?
In a word, stability. In India, the government officially demanded quick commerce platforms, Zomato, Swiggy.
The 10-minute delivery guys.
Exactly. They told them to cancel those deadlines. It was a clear political choice, prioritizing worker safety over consumer speed.
And what's the U.S. version of that? How are they putting the brakes on?
Here, it's a bit more complex. You have the administration putting pressure on the Federal Reserve and also introducing these new tariffs. The market is calling it tariff turbulence.
Which just means things get unpredictable.
And expensive. You get these wild price swings, huge delays. It's all friction.
Okay, so the cost of not running couriers into the ground and not relying on these fragile global supply chains is being passed directly to us.
That's the bottom line. Expects express delivery to either disappear or cost, what, 1.5 to 2 times more?
And financially,
Yeah.
with credit.
It's going to get tighter. Or you'll see more hidden fees as banks react to all this new regulatory pressure.
Right. This kind of heavy-handed intervention always creates a lot of tension. So how are the major news outlets even interpreting this massive pivot?
Well, it's a textbook case of polarization. On one side, you have what you could call the humanitarian necessity crowd.
They see it as great news for the workers.
Exactly. They frame it as essential. They focus on the value of human life and see higher prices as just the necessary cost of fairness.
Okay, but what about the financial press? I imagine they're not so thrilled.
Not at all. They're ringing alarm bells, citing a fall in profits for huge institutions like JP Morgan and BNY.
And why should the average person care about big bank profits dropping?
Because when a bank like JP Morgan anticipates losses, say, from government caps on credit card interest rates, they immediately tighten lending.
So your access to credit, your mortgage, your car loan,
Yeah,
all of that is directly affected.
right. So the public is split. One side accepts higher prices as a cost of being fair, while the other sees this as government interference killing their economic comfort.
And you, the listener, are caught right in the middle of that debate.
Precisely.
Let's get specific on the budget impact. Delivery and taxi services, they're going to cost more. That seems obvious.
It has to. If platforms can't squeeze that extreme speed out of workers for rock-bottom wages, the cost has to go somewhere.
But wait, is it really all passed on to the consumer? I mean, 100% of it. Where does the platform's profit adjustment come in?
That is the initial expectation, yes. These platforms are built for efficiency. When you introduce friction, they pass it on. And it's not just services.
Imported goods, too, because of the tariffs.
Of course, electronics, brand clothing. Get ready for price hikes from that turbulence we mentioned.
What about the other side of the coin? Jobs.
The labor market is definitely cooling. In the corporate sector, finding work is going to be harder. Bank profits are falling, and you're seeing big mergers.
Which always means layoffs.
Always. But for gig workers, it's a trade-off. The chance to earn that fast money through speed disappears, but the upside could be more stability, maybe even social guarantees.
So if we look at the most likely outcome here, what the sources are calling regulated friction, with about a 60% probability, what does my future look like?
Your future is a 45-minute food delivery. It's imported tech, costing 15 to 20% more. And it's a pretty sluggish job market.
Okay, so what should we be watching for to see how this plays out?
3 key indicators. First, just watch your delivery apps. Do the timers disappear? Or do you suddenly see a high demand fee even when it's not busy?
That's a good one. What's number 2?
Watch the central banks. If the Federal Reserve openly caves to political pressure and lowers rates while inflation is still high, that's a huge red flag. That triggers the really negative scenario.
And the third indicator?
Corporate reports. If major retailers like Amazon and Walmart start reporting profit drops right after the banks do, you can expect cost inflation to accelerate everywhere.
So this is a huge political bet, isn't it?
Yeah.
Sacrificing pure economic efficiency for social stability.
They're betting that you care more about your neighbor having a stable job than you do about getting dirt cheap electronics from overseas.
The biggest risk to you, then, isn't necessarily job loss right away. It's the loss of purchasing power as prices just keep rising.
That's it. So our conclusion is simple. Start adjusting your personal budget for the rise in service costs. Because it's coming, that's something to think about.